What is good, guys? Welcome back to the Investment Bible. Today we'll be talking about the current state of the U.S. economy, the difference between a recession and a depression, and what this all means for you. Last week we analyzed some of the stocks that Mark Cuban is invested in and talked about a few of the ways to assess the risk of a company. So please feel free to check that video out on our channel. With that said, let's get into it today. The economy is in some real turmoil, to say the least. Nearly 17 million Americans have filed new jobless claims in the last 3 weeks alone, starting in mid-March. This is a record, levels that we have never seen before. And on top of that, the Bureau of Labor Statistics, also known as the BLS, just reported another 5 million for this week alone, bringing the total to roughly 22 million. If you're not familiar with what a jobless claim is, they're just a statistic reported weekly by the U.S. Department of Labor that counts people filing to receive unemployment insurance benefits. Jobless claims is a proxy for layoffs. They provide temporary financial assistance for workers who lost their jobs. Social distancing has caused thousands of businesses to close up shop. Hotels, airports, you name it. This means cutting paychecks and employees. Growth in the economy has also taken a hit. Less people are consuming, less businesses are making money, less employees are getting paid. You get the picture. It all kind of comes full circle. Growth in an economy is often measured in terms of GDP, also known as gross domestic product. GDP is a total of all the goods and services produced in a country. In the US, 3 key factors drive growth: consumer spending, business investment, and government spending. In fact, consumer spending makes up 70% of GDP. We can say for sure that government spending is up, which we'll get to later in this video, but the other 2 components, well, they have absolutely plummeted. JP Morgan released its growth estimates, and I can tell you this, it does not look good. They believe that first quarter GDP growth will be a negative 10% and also drop their second quarter estimates to an insane negative 25%. They're just one of many banks that are estimating such a large contraction. I guess we'll just have to wait for actual GDP numbers to be released to see how bad the US economy has really been hit. So what exactly is a recession? Well, the technical definition is found right here on Investopedia. It literally means 2 consecutive quarters of declines in GDP. The National Bureau of Economic Research officially declares recessions, but doesn't really look at that technical definition anymore. They're more focused on the more up-to-date monthly data. If you think about it, you really don't know you're in a recession until it has already occurred. When GDP climbs back up to pre-recession levels, that's when the recession is over. The difference between a recession and a depression is that a depression is far more uncommon. It's also longer lasting. To put this into perspective, in the last 166 years, there have been 33 recessions and only 1 depression. The Great Depression of the 1930s is the most recent example, and well known. Economic depressions last years as opposed to months. So what does this mean for you? Recessions are a normal part of the business cycle. Typically, many businesses fail in a recession, since there's not enough demand and sometimes capital to keep the lights on. If government stimulus and bailout packages are not effective, then friends, families, maybe even yourself is at risk of getting laid off. Retirement accounts, 401ks, they'll all likely lose value. Not to fear though, it is all part of the cycle. It is unlikely that we'll see another banking crash, but there are definitely some serious implications to the American people if a recession is imminent. So now I'll turn you over to my boy to talk about the risk of recession and the things that Congress and the Fed can do to help us get out of one.
Everybody, I hate to be that guy, but the United States is going to see a recession. Bloomberg puts the probability of a U.S. recession occurring within the next 12 months at 100%, where just a mere few months ago, economists and analysts everywhere were saying the United States' historical economic expansion of the past 11 years was going to continue and there was no end in sight. That was until a black swan of event came called the coronavirus that put economies at a standstill all across the globe and even here in the United States. So if we agree we're going to see a recession, how are we going to get out of it? Well, here we have Jerome Powell and President Trump. Combined, they use fiscal and monetary policy to stimulate the economy. Trump and the legislative branch control fiscal policy, which focuses on government spending and taxes. In a time of a recession, the government will spend more money on things like welfare and unemployment in order to try and stimulate growth. We can already see this happening within the past weeks of the $1.2 trillion stimulus bill that was just passed by Congress. The government can also lower tax rates in order to incentivize people to spend their money. Now, on the left is Jerome Powell. This is the main guy when it comes to monetary policy. He is the Fed chair. What he does is involves interest rates and open market operations where the Fed tries to make sure there's ample liquidity in the market. This practice is commonly known as QE, or quantitative easing, and this was developed in the 2008 financial crisis mainly by Ben Bernanke. We recently saw 2 emergency rate cuts by the Fed, essentially bringing the federal funds target rate to zero. This is done in order to make lending money cheaper to promote spending and growth. The Fed has also agreed to buy corporate bonds as well as treasuries to help those companies that are distressed. One main problem is even during times of economic expansion, both the Fed and the government has dropped the ball in my opinion. During times of economic expansion, it is wise to raise taxes and lower government spending to be in a budget surplus, where in the past 4 years during the presidency, we have been in a budget deficit where the deficit of the United States has increased by almost $1 trillion per year. As well as this, the Fed has continued to pump money into the economy, which has some wondering, like myself, why they continue to expand their balance sheet these past years during times of economic expansion where the time to contract is now. This brings me to my next point of the United States federal debt levels. Currently, the United States has over $24 trillion of debt, and it has been growing rapidly since the financial crisis. This is the money that the government owes to anybody or anyone that has purchased U.S. Treasury bills or bonds. Most of this money was needed by the government to bail out banks and car manufacturers during the financial crisis. The Fed bought a majority of distressed assets from banks, majorly consisting of mortgage-backed securities, which are still sitting on their balance sheet today. The United States deficit is predicted to expand with no end in sight in the coming years. When you go online here, we have the national debt counter, which shows that we are indeed at $24 trillion of national debt. Of that debt, it consists of 112% of our GDP. Yes, you read that right. Our federal debt is higher than our GDP. That is nominal GDP. If you look at real GDP and where we take out intergovernmental debt, we are about 70% of our debt to GDP ratio. Historically, it has shown when a country sits at 70% of its GDP consists of debt, it never usually ends well. That is a concern for me, especially coming into this next recession, with the fact that fiscal and monetary policy is running out of weapons as QE has continued even after the financial crisis, and how we've been running a federal deficit for the past 4 years, even after we've been in expansion. It will definitely be interesting to see what will come and what will happen to all of us.
If you made it this far, thank you so much for watching our video. We'll be out with some more videos soon. Please feel free to check out our other ones and like and subscribe.